Welcome to The Explainer. So today we are talking about some absolutely massive stakes. Navigating the EB-5 program, you're literally putting hundreds of thousands of dollars on the line to invest in your U.S. immigration journey. And it turns out we have to look at this whole process almost like forensic accountants, really digging deep into the documents that truly govern that investment. Okay, let's dive right into this.
Right out of the gate, we've got to establish a hard, unavoidable truth. Only what is actually written down carries legal weight. Whatever a salesperson verbally promises you, whether that's a guaranteed timeline for a green card or some locked-in financial return, it means absolutely nothing in a legal dispute. Honestly, if it's not on the paper, it simply does not exist.
And this creates a pretty dangerous gap in the EB-5 process. I'm talking about the space between a really flashy sales pitch deck and the actual binding legal paperwork. The pitch deck, well, it might promise sunshine, guaranteed returns, and these perfect little timelines. But the legal reality dictates that your capital must be fully at risk and offers zero guarantees. This exact gap is where almost all investor disputes begin. If a broker gives you a verbal assurance but the actual document is far more cautious, the document wins every single time.
Section 1. Sales pitch versus legal paperwork.
So the baseline for all of this is the EB-5 offering memorandum. This is the core legal document that a regional center or developer is going to hand you before you commit a single dime of your capital. Basically, it bundles together a private placement memorandum, or PPM, along with a subscription agreement, an operating agreement, and the business plan. Together, these papers dictate exactly where your money goes, how the project is going to create jobs, and what happens if construction stalls or a loan defaults. It really helps have a solid grasp of this because this is exactly where the hidden traps usually sit.
Moving on to Section 2, Financial and Document Red Flags. Now, there are some undeniable telltale clues that'll reveal a bad deal. Let's run through them. First up, delayed or withheld documentation. Actually, let's just say it plainly. Legitimate funded projects do not hide their paperwork. Second, guaranteed returns. Listen, EB-5 law explicitly requires your money to be genuinely at risk. So any promise of a fixed guarantee is a massive red flag and frankly can even amount to securities fraud. Third, missing audited financials from an independent CPA. You need to know they can actually cover their obligations. Fourth, weak guarantors with no outside assets. And finally, unsecured debt. If your funds are sitting at the absolute bottom of the priority list for repayment, just totally dependent on some hypothetical future refinancing, yeah, that is a huge structural problem.
Take a look at this number, $60,000. You see, red flags often hide right inside the numbers, not just the text. If administrative fees are running above this specific amount, that can quietly and devastatingly eat into the project's ability to fund actual construction and job creation. This happens especially when the fee waterfall, which is just the strict order in which people get paid out, isn't clearly disclosed in the documents.
Which leads us directly into what I call the trust us forecasting trap. If you're reading a business plan and it relies on super vague language, or even worse, if the numbers miraculously shift depending on which section of the memo you're reading, be warned. This is almost never just a simple drafting error by a tired lawyer. It is a blinking, neon red sign that the underlying math simply does not hold up under scrutiny.
All right, Section 3, the job creation trap.
You really need to anchor yourself to this one crucial metric, 10. The project must create roughly 10 jobs per individual investor by the time of the IA-29 filing to meet those strict USCIS requirements. It's that simple. If the project misses this number, your petition is completely in jeopardy. It is so fascinating to see the difference between a project that's just hitting the bare minimum of 10 jobs versus one with a safe cushion of, say, 13 jobs. A well-run project is usually going to build in a 20 to 30% cushion based on hard construction costs, rather than just banking on speculative future operational revenue. If actual job counts fall slightly short because of, normal project variances, having a proper buffer protects your petition from outright denial. Projects that cut it close at the bare minimum are taking a massive gamble with your green card.
So you might be wondering, how are those jobs actually calculated? Well, job creation numbers absolutely should come from accepted economic models, specifically in-plan or RIMS-2 models, and they need to be prepared by qualified economists. That is the standard accepted methodology. The red flag to watch out for? A developer using an in-house spreadsheet that they magically label as proprietary. Guys, if nobody outside the company can actually verify the math, that is not a real methodology. It is literally just a marketing claim dressed up as math. Ensure outside parties can verify these calculations for sure. That brings us to Section 4. Overlooked risks and hidden fees.
It turns out there are quite a few structural challenges that can easily slip right past you in these thick offering documents. For instance, a novice U.S. developer might really struggle with local permitting. Or think about environmental risks. If a project is sitting in a floodplain and they just skip a standard Phase 1 environmental site assessment, you could be facing some massive regulatory delays. Even the Targeted Employment Area, or TEA analysis, is super strict now under the recent laws. Missing these details can lead to a petition denial without you even realizing it, all because TEA eligibility completely affects your investment structure.
Okay, I want to pause our investigation for just a second to ask what is probably the single most critical question when it comes to conflicts of interest in legal representation. Should you hire your own immigration attorney, even if the regional center is offering you one?
The answer to that is a definitive, absolute yes. You need to be incredibly cautious if a regional center is strongly recommending its own attorney while kind of discouraging you from seeking outside advice. A regional center's recommended attorney has an inherent conflict of interest, right? Their primary relationship is with the center. Independent counsel represents only your interests. And yes, it is an extra upfront cost, but in the context of an EB-5 investment, it is absolutely 100% worth it.
Finally, Section 5. Practical steps before you sign.
All right, so here is a really practical checklist we can take away from all of this. First things first, always request the full source and use of funds breakdown. Do not just accept a summary version. Second, go ahead and verify that TE eligibility directly, rather than just taking the developer's word for it. Third, check out the regional center's SCC history, as well as their USCIS approval and denial history. A center with nothing to hide is going to share this stuff easily. And fourth, read that repayment waterfall we mentioned earlier very closely. You're specifically looking for a trap stating that all investors must be approved first before anyone gets repaid. A clause like that can hold your money hostage for years.
Wow, okay, we've covered a tremendous amount of ground today, and you are now fully armed to act as your own forensic accountant. But I want to leave you with this one provocative thought before we wrap up. Does your project's paperwork actually match the pitch, or are you about to wire your funds straight into a trap? Seriously, don't just rely on verbal promises. Go grab your private placement memorandum right now, start matching up those claims, and protect your immigration future. Thanks so much for joining me on this explainer, and keep learning.